The Trump-Iran volatility catalyst: a single social media post could trigger a market dislocation by weaponizing geopolitical uncertainty. The core thesis posits that Donald Trump's hypothetical social media commentary on the Iran conflict represents a high-impact, low-probability event with asymmetric market implications.
This scenario transcends typical political noise, functioning as a direct test of market resilience against orchestrated narrative-driven shocks. The primary mechanism is not the geopolitical substance, but the amplification of uncertainty, potentially triggering a flight to quality toward you.
Treasuries and safe haven assets while pressuring risk on equities, particularly in sectors like technology, IPOs, and energy. The urgency stems from the market's demonstrated hypersensitivity to Trump's communication style, where ambiguous phrasing can instantly recalibrate algorithmic trading models and retail sentiment.
Weaponized communication as market infrastructure: the modern financial system is now intrinsically vulnerable to narrative warfare conducted via digital platforms. This vulnerability is not incidental but structural, built upon a decade of integrating real-time news sentiment into high-frequency trading algorithms and the proliferation of retail trading platforms that amplify herd behavior.
The status quo assumes a baseline of political communication. However, Trump's methodology deliberately bypasses traditional filters, creating a volatility shock that market infrastructure is poorly calibrated to absorb. The underlying drivers include the conflation of entertainment, politics, and finance in digital media ecosystems, where engagement metrics often outweigh factual analysis, and the deep market penetration of passive investment strategies that can exacerbate directional moves once triggered by a sentiment cascade.
Anatomy of a narrative-driven shock: market direction hinges on the post's perceived intent, strategic signaling versus deliberate disruption. A detailed analysis reveals two primary pathways.
First, a post interpreted as escalatory hinting at military action, would likely catalyze a sharp, knee-jerk market crash in equities, driven by fears of disrupted oil supplies from the Strait of Hormuz and broader regional instability, benefiting oil and gas equities initially before broader risk-off sentiment prevails.
Conversely, a post framed as de-escalatory or victorious could trigger a short-covering rally, particularly in defense stocks and the dollar index. The critical variable is Trump's inferred market positioning. Allegations of prior knowledge or market manipulation introduce a layer of reflective uncertainty where traders attempt to front-run his personal financial incentives, creating a feedback loop that destabilizes price discovery in cryptocurrency and other sentiment-sensitive assets.
Verdict: engineered uncertainty prevails. The immediate market reaction will be negative, but the structural damage to trust poses a greater long-term risk. The strategic verdict is that any such post, regardless of content, injects a toxin of uncertainty into the market, making a transient crash more probable than a sustained rally in the immediate 24-48-hour window.
The predicted consequence is a spike in the SIBO Volatility Index VIX and a bid for long-dated U-bonds, reflecting a flight to safety.
The final assessment indicates that the greater systemic risk is the continued erosion of the market's fundamental pricing mechanisms as repeated narrative shocks degrade the signal-to-noise ratio for investors. Strategic next steps for institutional players involve increasing hedge ratios, using options, and diversifying into non-correlated assets, while regulators face mounting pressure to define and police digital communication as a potential market abuse vector in an era of continuous informational warfare.